I've got Cinthia Murphy joining me here to begin the conversation as we take an ETF-driven focus, but also just a market focus. Always a great mind to have as an ETF expert. Cinthia, good to see you again. Happy New Year.
Happy New Year. It's good to be here.
What is top of your mind when we're starting off the year? Markets look like they're in rally mode again pretty clearly. Is that following on the flows? Do you expect that to start getting pretty juicy again or what?
Yeah, it's like listening to you do the opening remarks here and the smooth sailing and the Mag 7 and the big tech story. It's interesting because, you know, in the ETF space, the conversation has been so focused on the other side, the defense plays, the small caps, the value, the quality. And so there's a little bit of a dissonance there in terms of the flows. But, you know, the problem of making a lot of assumptions based on the flows is that flows are a laggard indicator at best. So we can see where money has come in, doesn't mean that there's money is going into. So it's just been interesting how a lot of to your point earlier about the broadening of the rally, I think that equates what we see in the ETF space. You know, so maybe it's not just about defense, it really is about broadening that scope of exposure. So we haven't seen investors really give up on their large cap, on their big tech stocks, on their Mag 7, but we have seen them added to the other side, your value plays, a big focus on quality right now, your small caps, so those other parts of the market.
That's important that they're not taking the money out of tech. There were some moments in the last year where it looked like that was kind of a zero-sum trade. If we were going to rotate, it'd have to come at the price of taking money out of tech. But if the flows are still positive, then that doesn't really look like it's going to be the case.
Yeah, and I love that idea because I think we always make that connection of a rotation means out of one and into the other, but it really can just be, I think, more of as an expansion. So maybe you diversify a little bit, maybe you take a little bit from your growth and your tech and you go into other parts of the market, but it doesn't mean you have to give up one for the other, and that's what we're seeing in the flows.
Tell me about the numbers so far this year. I mean, it's early, but it's also, you know, we're moving here a couple weeks in.
Yeah, it's early, but we have already about $60 billion come into ETFs in a couple weeks, which is really strong. It's stronger than last January, for example. The bulk of that appetite is in equities, so people are chasing that equity performance. There's some interesting demand there, really growing for some thematic opportunities associated with the incoming administration. There's strong demand for Bitcoin. I think almost $2 billion have already gone into Bitcoin ETFs this year. So, you know, some of these winning segments continue to lead.
Does that look like the preferred way to express a Trump 2.0 bet right now? Is crypto the place to do it? Is that where you see an expression of the new admin? I
think there's definitely a positive sentiment in crypto as it relates to Trump in terms of regulatory support and all these things we've talked about a lot in the last couple months. But I'm also seeing a lot of money go into banks, financials, which is, you know, part of, you know, the idea of lower regulation, good for banks. So some of these classic themes associated with Trump, we're seeing that again. We're seeing money go into defense stocks, a lot of defense ETFs, really making a lot of headlines. And there's an interesting fund, AIRR, from First Trust, which is an American Renaissance ETF that tracks Richard Bernstein index. And so heavy industrials, heavy banking, and it's taken more than $600 million in 2 weeks. So, So that whole domestic theme, U.S. first, growth of the domestic infrastructure, all the ETFs that tap into that are gaining.
Sounds like the last one there might be somewhat of like a capital markets play with the bank connection, maybe a little bit. Yeah,
banking, also securities and exchange, like exchanges, all these kinds of financial plays are strong right now.
The other one, the defense, I know that a lot of people go, all right, Republican guy, defense spending, but then there's also this promise that he's going to end the global wars. So it's like, you know, some of these policy trades get a little bit
but if you talk to some of these portfolio managers, the idea is that peace actually requires big investment. So it's not just about investing in weaponry. It really is, you know, investing in infrastructure, investing in the more you invest and the stronger you look, the less likely you are to have war and have peace. So it's kind of an interesting story there. But we're seeing things like SHIELD from Global X, there's PPA, there's a lot of ETFs that are.
SHIELD is interesting, that's a good defense ETF ticker.
Very good.
How come nobody's done a Trump 2.0? The return fund, like, I'm kind of surprised there's no ETF out there in the works that's like a targeted.
Maybe nobody wanted to bite that marketing bullet. I'm not sure.
Yeah, because they have done. There's been a few like that before that have kind of like skewed, like right or left, like politically oriented. There's one that tries to track like the trades of politicians.
Right.
But I'm kind of surprised at the way ETFs now, people come up with stuff so fast, and with all this excitement around the Trump 2.0 since the election, nobody did like a TRP or something.
Actually, I'm kind of glad that didn't happen because I like just the idea of long-term thinking here. I mean, we get so much spaghetti.
What do you do with that after 4 years?
Exactly. And what if nobody's happy after 100 days, and then what? You have this fund that you're paying to keep alive for what? So maybe we don't need it.
Sounds like the crypto stuff is doing somewhat of an adequate job kind of placeholding to some degree to like find one of these high conviction policy themes and go through that route.
Listen, what's interesting about the crypto to me is we do a lot of advisor surveys at Verify, and we recently did one on crypto along with Bitwise. And we learned that more than 56% of advisors who respond to a survey said they're planning to increase exposure to crypto for their clients. That's a big number. The other thing that we've learned is that that demand is not taking away from things like blockchain or the entire crypto ecosystem type of plays. It's in addition to. So I think there's really kind of like a positive, growing positive sentiment towards crypto as an ecosystem, at least in the advisory channel. That's really interesting, and it suggests like positive momentum going forward.
It seems like the logic is pretty straightforward at this point. When the guy running the show at the top is surrounded by people who love it, then it kind of trickles down to become more widely accepted.
It tells you that just the importance of policy and regulation on everything we invest in. So when you get a sense that the forces that may be will be conducive to that investment, it just opens all sorts of doors, whether that's crypto, whether that's banks, whether that's even tech stocks, AI, all of that, right?
Do you see anything that folks are looking at as a hedge to any of this? Or is it kind of pure risk trying to find beta attached to markets that are going to go up? Is there anything, are there flows coming to any of the protective stuff? I feel like the last year we had a lot of that stuff getting launched. Buffered funds, guaranteed outcome stuff. Like, is that stuff going to fall behind now?
I think, no, we're still seeing flows. Like, there's things like the buffered stuff, the managed floor ETF series, the laddered option strategy. So you don't have to time, it doesn't reset once a year. So it's kind of like a core position. Those types of funds like SFLR are gaining assets. HELO, H-E-L-O, which is a hedged equity ETF, has picked up a lot of assets this year. So there's definitely a downside protection feel. There's definitely an appetite for some protection as, the caution. We were seeing that. And I think we're seeing that in the dividend space too. There's a lot of money going into dividend payers, especially dividend growers, which is kind of a quality. I think all these quality tilts are in a way a defensive play, trying to minimize that risk for risk's sake. Try to be more conservative there.
I track QUAL a lot as the quality factor. Is there any twist on that factor that I should be looking at this year in addition to kind of the basic sort of balance sheet driven financial quality filter that fund puts on?
No, that fund is super popular. It has picked up a lot of assets. I mean, from a valuation perspective, I think it's trading at a trailing PE of like 25 versus 29 for S&P 500. So there's a little bit of a valuation tilt there that's interesting. I really like things like DUHP, for example, from Dimensional Funds, which is a high profitability ETF. So it's like really like tangible quality. I mean, profits are profits versus a murkier definition of quality that depends on who you're talking to. So I think that DUHP is a great complement to your classic value plays, so that you can balance the quality and value out. So there's interesting plays there for.
Interesting. Okay. Yeah. So they're a little bit. Is it a little bit more active share, I guess?
Yeah. Absolutely.
Okay.
Yeah.
Interesting. DUHP. All right. One to add to the list. All right. What are the other? Is there like a New Year, New Me ETF? People like the resolution ETF? Or?
So as far as themes, I guess one thing that we've been following close is the GLP-1, the lose weight. I mean, I'm sure you've watched every other commercial on TV everywhere is about lose weight.
Yeah, a lot of those original stocks are getting hit hard. Novo and
Eli Lilly, yes. But as you know, in the ETF space, these funds are brand new. There's two of them that just launched, and one of them that kind of converted into the GLP-1 story. Thinner is one ticker, THNR. The other one is Ozan. Thinner is actually, it's a VettaFi index with Amplify. And so these are the long-term plays. So as you know, some of these thematic plays, right now it's kind of a hot story. It's New Year's resolution. But for a theme to really work, I think it has to have a long-term time horizon. And I think this is one of them. There's so much drug development coming into play, and we're going to be watching that closely.
I wonder if any of it will bounce off each other, though, as an investment, if there's so much competition. It's kind of a race to the floor for margins. I mean, I think that's kind of why Novo and Eli Lilly been getting hit a little bit, because there's like this massive like early land grab, and now it's all getting chopped up among a bunch of different players.
Oh, and they're trying to they have to lower the price to increase the access, and now they're talking about from injections to pills. You know, what's the margin on those, and looking for approval. We know FDA approval for everything costs a lot of money, so big R&D investment and approval investment. So I think it's a big expense at the moment, but if you believe in what these drugs can do and the development behind them, you know, it's a long-term opportunity here that I think is interesting.
All right, some good tickers in there too. Always food for thought and great ideas. Thanks a lot, Cinthia.